Okay, so you ever feel like you're just drowning in information, especially when you're trying to, get up to speed on something complex fast?
Oh, absolutely. You want to be informed, but who has the time to read everything?
Exactly. Well, that's what we're here for. Welcome to the deep dive. Today, we're going to try and cut through some of that noise.
We're giving you a shortcut, really, to understanding a truly foundational piece of finance.
That's right. We're diving into Benjamin Graham's classic 1949 book, The Intelligent Investor.
Yeah, it's pretty much known as the book on value investing, and there's a good reason for that reputation.
So our goal today, unpack the really important bits, maybe some surprising things from the material we looked at.
We'll walk you through where it came from, its core ideas, why it still matters, and, keep it interesting. No dense jargon, promise.
Definitely. Okay, let's get into it. The genesis of this classic, Graham publishes it in 1949. But the ideas, they started earlier, right?
Yeah, way earlier, actually. The strategies in the book, they're based on this thing called value investing. It's an approach Graham started teaching at Columbia Business School back in 1928.
Wow, 1928. So this wasn't a reaction to some recent crash. It was a long-term philosophy he developed with David Dodd, too, I think.
Exactly. They refined it together. And the impact, it's huge. Think about Warren Buffett. Probably the most famous investor out there.
Right. Everyone knows Buffett.
Well, he read The Intelligent Investor when he was just 20, and he basically built his entire career on its teachings.
Didn't he say something pretty strong about it?
He did. He called it, and I quote, by far the best book on investing ever written. That's about as strong an endorsement as you can get.
No kidding. And it wasn't just him, was it? The material mentions other Graham disciples.
Yeah, people like Irving Kahn, Walter Schloss, a whole generation of really successful investors who followed his principles. It just shows how deep the influence went.
So what was it about this approach? What made it click for so many smart people?
I think it's because Graham offered a rational framework. In a world that's often driven by panic and hype, he gave people a logical, disciplined way to think about investing.
Okay, so let's define it then. What exactly is value investing at its heart?
Well, the core idea, based on the sources, is that it's a strategy targeting undervalued stocks. Stocks of companies that are actually solid businesses capable of doing well over the long run.
Undervalued.
Yeah.
So looking past the current market buzz or negativity.
Precisely. Value investing is not concerned with short-term trends in the market or daily movements of stocks. That's key.
So it kind of ignores the day-to-day drama.
Right. The belief behind it is that the market often freaks out. It overreacts to price changes in the short term, and it doesn't always consider a company's fundamental strengths for long-term growth.
So people are buying high and selling low based on emotion.
Often, yeah. Value investors try to do the opposite. The basic idea is, look, if you know the true value of a stock, then you can save lots of money if you can buy that stock on sale.
Like finding a hidden gem at a discount. Makes sense.
Exactly. But here's something interesting more. Graham himself actually changed his tune a bit over time. He deviated from his earlier work, security analysis.
Oh, how so? That book's a classic, too.
It is, but later on, instead of recommending, super extensive analysis on an individual company, which was the original focus,
Yeah.
he shifted to what he called the group approach.
A group approach. Okay, that sounds different. What did that involve?
It was quite a shift. He basically suggested investors should try to buy groups of stocks that meet some simple criterion for being undervalued.
Simple criteria. Like
Right.
what? And groups, not individual deep dives.
Right. Regardless of the industry and with very little attention to the individual company, he found the results were, surprisingly good.
How good, did he say?
He did. He said the results were very good for 50 years. They certainly did twice as well as the Dow Jones. That's
Yeah.
pretty compelling.
Wow. Twice the Dow for 50 years just using simple criteria. No wonder his enthusiasm transferred from the selective to the group approach.
Yeah, he mentioned looking for things like an earnings ratio twice as good as the bond interest ratio for most years, or using a simple dividend criterion or an asset value criterion.
Yeah.
Very pragmatic.
It shows he was willing to adapt based on evidence, even late in his career.
Absolutely. Now, connecting this to the market's behavior, one of Graham's most famous ideas, something that really sticks with you, is the allegory of Mr. Market.
Ah, yes, Mr. Market. I love this one. He's like the personification of the stock market's mood swings, right?
Exactly. He personifies the irrationality and groupthink of the stock market. Graham describes him as this Obliging fellow.
Yeah, who turns up every day at the shareholder's door offering to buy or sell his shares at a different price.
And sometimes his price seems reasonable, plausible, but other times, sometimes it is ridiculous.
Yeah. But the key is the investor doesn't have to deal with him.
That's the genius of it. You are free to either agree with his quoted price and trade with him, or ignore him completely.
And Mr. Market doesn't care. He'll just be back the following day to quote another price. It puts the power back in the investor's hands.
Totally. So the lesson Graham is teaching here is crucial. You should not regard the whims of Mr. Market as a determining factor in the value of the shares the investor owns.
Don't let his daily mood dictate your view of your own assets.
Exactly. Instead, you should profit from market folly rather than participate in it. Focus on the actual business performance, the real-life performance of his companies, and receiving dividends.
Right. Don't get caught up in Mr. Market's often irrational behavior. Okay, so if we ignore Mr. Market's crazy prices, how do we know what a stock is actually worth? How do we find that true value?
Well, that brings us to the science, or maybe the art, of valuation. Graham stresses that determining the value of companies is essential if you want to invest successfully and, crucially, avoid participating in short-term market booms and busts.
Makes sense. So what's the method?
The method is called fundamental analysis. Graham actually proposed a mathematical way to think about it.
Okay. Math. Lay it on us gently.
Haha, it's not too bad. Basically, he suggested value can be estimated by multiplying forecasted earnings over a certain number of years times a capitalization factor of a company.
Okay, forecasted earnings times a capitalization factor. What's that factor based on?
Good question. That cap factor is like a multiplier that adjusts the earnings based on the company's quality and risk. Material lists 5 factors that go into determining it.
5 factors. Got it. What are they?
Okay. They are long-term growth prospects, quality of management, financial strength and capital structure, the company's dividend record, and its current dividend rate.
Right, so things that tell you about the health and future of the business itself.
Exactly. Each one helps you decide how much you should value those future earnings. Stronger company, higher factor, basically.
And where do you get all this info? Is it hard to find?
Actually, no. Investors use the company's own financials, annual reports, cash flow statements, EBITDA figures, plus what the executives are saying about forecasts and performance.
EBITDA. That's earnings before interest, taxes, depreciation, and amortization, right? A measure of core profit.
That's the one. And the great thing is, this information is all available online. Public companies are required by the SEC to disclose it, so the data's out there for you.
Okay, so the tools are there. Now, there's another key concept mentioned prominently in the book's contents, margin of safety.
Yes, margin of safety. This is huge. It's listed as the central concept of investment.
The central concept. So what is it?
It's actually beautifully simple. It means buying something for significantly less than your estimate of its true or intrinsic value.
So if you figure out a stock is worth $100.
You don't buy it at $99 or even $90. You wait until Mr. Market is having a really bad day, maybe offers it to you for $70 or $60. That difference is your margin of safety.
Okay, and why is that buffer so critical?
It protects you. It's your cushion against, well, against being wrong in your calculations, which happens, or against unexpected bad news for the company, or just plain old market craziness going further than you thought.
So it builds in room for error.
So
protects your downside.
Exactly. It's about making your investments resilient. It protects you from the uncertainties you just can't predict. It's fundamental to the whole philosophy.
You can really see why Graham is called the father of value investing. The book was, and still is, highly regarded.
Absolutely. Professor Ronald Moy pointed out the influence of Graham's methodology is indisputable. Look at his disciples, Buffett, Bill Ruane, Walter Schloss, a virtual who's who.
And it's not just academics. Ken Falconberry, an investment planner, said, if you could only buy one investment book in your lifetime, this would probably be the one. High praise.
It really is. And what's amazing is how relevant it stays.
Yeah, the material notes that many of Graham's investment strategies explained in the book remain useful today despite massive growth and change in the economy. How does a book from 1949 manage that?
I think it's because the core principles are about human behavior and business fundamentals, which don't change that much. Scholar Kenneth Roos highlighted its clarity too.
What did he say?
He said it continues to provide one of the clearest, most readable, and wisest discussions of the problems of the average investor. It wasn't just for Wall Street pros, it was meant to be accessible.
That accessibility is probably key to its longevity. And the book itself wasn't static, right? It was updated.
That's right. Graham revised it himself several times. The last big one he did was in 1971-72, leading to the fourth revised edition in 1973.
And that's the one Buffett contributed to.
Yep, that edition included a preface and appendices by Buffett. Graham passed away in 76, but the book lived on.
And there were later updates, too.
Yes. In 2003, Jason Zweig added commentaries and new footnotes to that fourth edition, kind of bridging the gap for modern readers, explaining context from the 70s.
So keeping it current.
Exactly. There's even mention of a 2024 third revised edition, and an unabridged audiobook came out in 2015. It just shows this ongoing effort to keep Graham's wisdom alive and accessible.
Wow. Okay, so wrapping this deep dive up, The Intelligent Investor really stands out as this, well, timeless guide. It's about discipline, looking at the long term.
Yeah, focusing on real value, not just market noise. It's about fundamentals over fleeting sentiment.
And understanding these ideas, it really empowers you, the listener. It helps you think critically about information, make more informed choices. Not just in finance, but maybe other parts of life, too.
Absolutely. And maybe a final thought to leave you with. Think about that Mr. Market allegory again.
Okay.
It's not just about stocks, is it? It's a metaphor for that kind of irrational groupthink we see everywhere.
Yeah.
Social media trends, news cycles, maybe even politics sometimes.
That's interesting.
So the question to mull over is, where else in your life could you benefit from recognizing the market folly, stepping back, and choosing not to participate in it?